Hi everyone, welcome back to Finexa, where finance meets clarity. In today's video, we're going to break down the concept of capital budgeting with real-life examples and formulas. If you're a student, business owner, or finance enthusiast, this one's for you. Capital budgeting is the process companies use to evaluate long-term investments, like purchasing new machinery, launching a product, or opening a new branch. These decisions involve large amounts of money and can affect a company's future growth, so it's critical to choose wisely. Now, let's explore the types of capital budgeting. Number 1. Net present value. This method calculates the current value of all future cash flows generated by a project, minus the initial investment. If NPV is positive, the project is expected to add value. The formula is NPV equals cash inflow divided by 1 plus R to the power T minus initial investment, where R equals interest rate and T equals time. Number 2. Internal rate of return. IRR is the discount rate that makes the NPV of the project zero. In simple terms, it's the expected rate of return of the project. If IRR is higher than the company's required rate of return, the project is attractive. The formula is IRR equals R1 plus NPV1 divided by NPV1 plus NPV2 multiplied by R2R1, where R1 equals lowest rate, R2 equals highest rate. NPV1 equals the net present value calculated using the lower guess rate. NPV2 equals the net present value calculated using the higher guess rate. 3. Payback period, PBP. This measures how long it takes to recover the initial investment from the project's cash flows. Shorter payback periods are usually preferred, especially when liquidity is a concern. The formula of PBP is A plus NCO minus C divided by D, where A equals last year before full recovery, NCO equals initial investment, C equals cumulative cash inflow at the end of year A, D equals cash inflow in the following year, A plus 1. 4. Profitability Index, PI. It's the ratio of the present value of future cash flows to the initial investment. A PI greater than 1 means the project is profitable. The formula is total PV of cash flow divided by initial investment. Here's a fictional investment case study using the company Apple Inc., applying the concepts of NPV, IRR, PBP, and PI, all calculated step by step. This is not based on Apple's real data but is crafted to simulate a real business decision Apple might make. Let's get into it. Apple Inc. is considering launching a new smart wearable product. To support the product, Apple will invest in a new production line. Investment details. Initial investment, $50 million. Project lifespan, 5 years. Let's have a look at the expected annual cash flows. In 2026, the cash flow is $12 million, $14 million in 2027, $16 million in 2028, $15 million in 2029, and $13 million in 2030, respectively. Let's get into financing. Step 1 is NPV. Now let's solve the NPV using the given data. By putting all the value accordingly, the NPV is $2.81 million. Here the NPV is $2.87 million, which is greater than 0. Apple should accept the project. Calculating the IRR and let the R2 be 15%. Now substituting the values in the NPV formula, we get the result of NPV2. The result is in negative, minus $3.37 million. Here, R1 equals 10%. From step 1, NPV1 equals $2.87 million. From step 1, R2 equals 15%. NPV2 equals minus $3.37 million. Now calculating the IRR by putting the value according to the formula. The IRR is 12.3%. IRR equals 12.3%. IRR approximately equals 12.3% greater than 10%, right pointing arrow acceptable. Apple's required rate of return, also known as the cost of capital or discount rate, is 10%. Interpretation. When IRR, required rate, 10%, it means the project is expected to generate a return higher than the minimum Apple requires to justify the investment. Remember this decision rule: if IRR is greater than 10%, accept the project. If it is less than 10%, reject it. Now calculating the payback period. From the data, first we find out the cumulative and then find out the values. Now putting the value, it has come to the conclusion that the investment of Apple will be recovered in 3.53 years. Step 4: Profitability Index. The final step. The formula of Profitability Index is the total PV of cash flow divided by initial investment. In our Apple case study, total PV of inflows equals $52.87 million. Initial investment equals $50 million. After putting the value, the answer is 1.05 respectively. Interpretation of the result. Pi of 1.05 means that for every $1 invested, the project is expected to return $1.05 in present value terms. That includes, $1 equals the original investment. 5 cents equals the profit or value created per dollar. The decision rule for PIR. If the value is greater than 1, the interpretation is value creating project and the decision can be accepted. If it is equal to 1, the interpretation is break even and the decision will be neutral. And if it is less than 1, then it will destroy the project value and it should be rejected. This was all about the capital budgeting chapter. Thanks for watching. If this helped you understand NPV better, don't forget to like, comment, and subscribe to Finexa for more finance breakdowns made simple.